Hey, what's up everybody, and welcome to the Keystone Financial Academy. Today's video is all about debt, including all the different types out there, how to minimize or avoid it, and how to pay it down quickly. Before we start, please subscribe to the channel so you don't miss any of the upcoming financial and investing videos. And if you enjoyed this video and found it useful, please hit the like button below. Okay, let's talk about debt. Now, strictly defined, debt is money that you owe to someone else, usually a creditor, but most people define it as something that causes them constant stress. Now, this is a relatively unpleasant topic to talk about, but a really important and necessary one. It's important to first note that debt has a positive side. Without debt, most of us wouldn't be able to buy homes, cars, or send our kids to school. It's the same thing in the business world. A lot of businesses use debt to start up, expand, and really it's one of the components that make our economy grow. The problem is not so much debt, but when debt overwhelms our life and our ability to repay it. Debt should be a relatively minor component of your personal financial situation and not grow to be an all-encompassing entity. Yet, here we are as a nation. We're kind of drowning in it. We acquire debt early. Student loans, credit cards, car loans, your first mortgage. It's all pretty easy to rack up and very tough to get rid of. Of course, it doesn't help that we live in an economy that's driven kind of by consumer spending, and with historically low interest rates and easy access to credit, it practically begs for debt to be racked up. How in the hole are we exactly as a nation? Well, as of 2019, we have $868 billion of outstanding credit card debt, $1.2 trillion in car loans, and $1.4 trillion outstanding in student loans. The total national consumer debt for that year approached $14 trillion, with most of that, of course, being mortgages. The average American now carries about $38,000 in personal debt, not including mortgage, and in 2019, only 23% of adults that were surveyed said they have no debt whatsoever. So for the other 80 or so percent of adults that do have debt, paying it off is very much doable and should be a priority if you're trying to establish financial security and grow your wealth. Let's go through the concepts of debt piece by piece and see what can be done to actually accomplish this. When discussing debt, you first have to classify it into two categories: secured debt and unsecured debt. A secured debt is one that's backed by tangible collateral, not just the creditworthiness of the borrower. Secured debt includes mortgages and car loans, and these generally carry a lower interest rate because the lender has a lien on a physical asset, a house, a car, that they can repossess in case the borrower defaults. Hence, it's less risky for the lender and hence the somewhat lower interest rate. An unsecured debt is one that is not backed by any sort of physical collateral and is based entirely on the creditworthiness of the borrower. These types of loans are considered riskier as there is nothing physical that the lender can repossess. Therefore, they'll charge a higher interest rate in order to offset this risk. The best known type of unsecured debt is a credit card, but there are other types. Okay, let's look now at the different types of debt you can have and then go through the list again and look for ways to minimize it. The first is mortgage debt, and this is of course the money you take out to pay for your primary residence, and it is secured by a lien on the property. The second is auto loan debt. This of course is the money you borrowed to purchase a vehicle, and it is a secured loan with a lien on the vehicle. The third is student debt, and this of course is money borrowed to go to university, college, training program, or any other kind of educational institution, and this type of loan is of course unsecured. The fourth is credit card debt, and this is money that you borrow via a credit card to make purchases, and this type of loan is unsecured. The fifth is medical debt. This is money that is borrowed or is used to pay for medical procedures. This debt accrues mostly due to lack of or inadequate medical insurance coverage, and it is also unsecured. Finally, we have IRS or state tax debt. This is a type of debt you accrue as a freelancer where you don't pay enough of your quarterly taxes and then you owe money to the IRS or the state, and that kind of debt is of course unsecured as well. Now, I mentioned earlier that there's a positive side to debt, and indeed there's a good debt and a bad debt, and it's important to differentiate between the two. A good debt is something that will allow you to acquire something that will grow in value or generate income and therefore increase your net worth. A lot of good debts have very low interest rates. A bad debt, in contrast, is when you acquire something that will lose value and not generate any income for you, or basically anything that loses loses money for you and lowers your net worth. Bad debts often carry high interest rates. What are some examples of a good debt? Probably the best example is a mortgage for primary residence where you live. You're buying a house, a historically appreciating asset with some great tax advantages. Another good debt could be a student loan to attend school. If what you're learning will make you good money upon graduation, then it's a good investment and a good debt. If not, it may turn out to be a pretty bad debt liability. Car loans are in a bit of a gray area. If you buy a car and you use it to directly make income, such as being a delivery driver, an Uber driver, or indirectly by allowing you to get to work, then it's a good investment. But if the vehicle is extravagantly expensive and you can't afford the car payments, then it crosses over into bad debt. Credit cards are another type of bad debt, but even here there's a little bit of a gray area. For example, if you use your credit card to purchase a powerful computer and some software to launch a graphic design business, that is an investment and can potentially be considered good debt, especially if you pay it off right away. On the other hand, putting a gaming console on your Visa doesn't really qualify. As you can see, it's often the intent and the extent of the debt being taken on. Even with good debt, there's a limit to how much you can overextend yourself before it crosses over into bad debt. Okay, let's go through the 6 types of debts introduced just a little bit earlier and see how we can minimize each one of them. We'll start with mortgage debt. Now, it's difficult to completely avoid mortgage debt unless you're one of the 20% of the population that can pay in cash. Unfortunately, most of those are deep-pocketed investors who are buying houses for investing purposes. So we'll assume you'll have to take out a mortgage like most people do. So what can you do to save money on the mortgage payments? Here are a couple of approaches. Probably the number one suggestion on how to save money on mortgage payments is not to purchase more house than you can afford. Especially if you're purchasing your very first house, there's probably no need for a McMansion oversized home. And as a general rule, the value of the home you're considering to purchase should not exceed 4 times your household annual income. The second tip is to try to save up for 20% down payment on the home. That way you can avoid PMI or private mortgage insurance, and you might also secure better interest rates on the loan. The third tip is to shop your loan carefully, especially if you have excellent credit. You can save quite a bit on the interest on your mortgage by comparison shopping, even in a low rate environment such as now. Run a calculation to see if paying points to lower your interest rate even further is worth it for you. It generally does if you're not selling your home for a certain number of years. Okay, next let's talk about auto loans. Avoiding auto loan debt should be a lot easier than avoiding mortgage debt for the simple reason that cars cost a lot less than a home and you should be able to pay for a good chunk of it in cash. That is, however, though, the same reason people get into auto loan debt, because cars cost a lot less, are easier to acquire, easier to show off, and everybody wants the latest and greatest model. Let me state an important fact here. Cars are not an investment, they're an expense item and a quickly depreciating asset. With that in mind, here are some approaches to avoid auto loan debt. The number one way to avoid auto loan debt is to not get an auto loan and instead purchase a reliable used car in cash. Letting the previous owner take the depreciation hit will save you a tremendous amount of money, and you can still get an excellent 2 or 3-year-old used vehicle by shopping the most historically reliable manufacturers. If you must get an auto loan, get it from your own bank or credit union, not the dealership. And when at the dealership, negotiate the car price aggressively and watch out for the junk fees that the finance office can impose upon you. There'll be quite a few videos coming up in the future on purchasing and leasing used and new vehicles. There are major auto insurance savings possible if you buy a used car and pay it off in full. You can then just get liability and not collision coverage. The reasoning is that with an inexpensive used vehicle, you can pay for your own repairs out of pocket in the rare event of an accident. However, always be sure to keep the highest possible liability insurance that you can afford. Finally, another possibility to save money on your car payments, at least prior to this pandemic of 2020, was to lease your car out on a service such as Turo.com. The upside is that even the couple $100s you could have made per month in just occasional renting will either offset your whole car payment or pay for a good chunk of it. However, the downside, of course, is that the wear and tear on your car, and you won't have use of it for at least a couple of days out of the month that you're renting it out. This sort of car business has, of course, slowed down quite a bit with the COVID-19 pandemic, but once that's behind us, it's expected that travel will pick back up again and renting cars will be profitable again. Okay, next, let's talk about student loan debt. Student loan debt is a really fast-growing debt burden, outpacing credit cards and car loans here in the US. Getting educated is a necessary and worthy goal, and there are ways to at least, if not eliminate, lessen this type of debt. At the risk of stating the obvious, the best way to get a free or low-cost education is use someone else's money. This generally refers to academic or sports scholarships, scholarships, grants, or other types of tuition reimbursement. If you qualify for any type of scholarship, even a partial one, definitely take it. And if your company pays for graduate school, which a lot of them do, don't delay in taking advantage of that. Also, research if your personal situation entitles you to some help from either the government or the school of your choice. And be sure to exhaust all public sources of funds before turning to the private loans. The second very well-known way to avoid any kind of higher education expenses is have the military pay for it by enlisting in one of their services. However, that is a major life decision which we won't get into in this video. If you can eliminate educational expenses, the next best thing is to minimize them. One well-known way is, of course, to go to a state school versus a private one, or go to a lower division 2-year community college for the first 2 years of your 4-year degree, and only then transfer to an upper division. There are over 1,100 community colleges in the United States, and they are a bargain. And many, if not most, deliver an education that's actually on par, if not better sometimes, of the equivalent first 2 years at a major 4-year university. Okay, next, let's talk about credit card debt. This is perhaps the most important kind of debt to avoid given the sky-high interest rates on unsecured credit cards. It can also be the hardest one to control due to the ease of use of credit cards. However, you have to remember and never forget that your credit card limit is not your money, it's the bank's money. You are borrowing it when you're making a purchase from the bank that issued you the card. The best possible financial advice in regards to credit cards is the following. Only have one credit card and always try to pay off the balance with cash from your account at the end of the month. As your income and net worth increases, other credit cards may be justified, and there are a lot of videos out on YouTube for the best credit cards of 2019 and 2020. And in fact, wealthy individuals do have numerous credit cards in order to collect benefits from using each one of them. However, these people always pay off their balances. That way they can just collect the benefits from the cards and never be charged for the high interest rates in the balances. In all cases, you just want to pay it all off on time. Next, let's talk about medical debt. This type of debt has been the leading cause of bankruptcies in the US for quite a few years now. If you're young, this is something you can somewhat avoid, but even staying healthy is not a guarantee that you won't have an accident or some sort of emergency. Try to get medical coverage at the first possible opportunity, and even a low-cost, low-coverage plan is still better than no plan at all. And always consider the coverage offered by an employer before accepting any position. If you're a business owner or freelancer, you can purchase health coverage and write it off as a tax deduction. The bottom line with medical debt is you should try to do everything you can to avoid this #1 cause of debt and bankruptcies in the US. Okay, finally, we need to talk about tax debt. Now, most people are W-2 wage earners, means they get the right amount of taxes taken out of their paycheck. However, this topic really concerns freelancers. It's the folks that work on a 1099 basis and they have no taxes withdrawn, and what they have to do is pay taxes at the end of the year. However, because it could be such a large amount, they're supposed to pay quarterly, 4 times a year. If they don't, this tax bill can add up, and at the end of the year they might not have the amount of money they need to pay off this tax bill, and they end up getting into tax debt. This tax could be owed to the IRS or to the state. So best bet, set aside 25% of all your gross income for taxes. Put it away into an interest-bearing account, such as a money market account. Let it sit there until the quarter is over. So if you start in January, February, at the end of March, you'll pay that amount and continue it for every quarter of the year. That way, at the end of the year, you won't be stuck with a huge tax debt. Okay, so after going through these 6 major categories of debt, let's now talk about ways you could pay off debt if you already have it. Now, paying back debt may sound pretty self-explanatory, as in like, duh, just pay it back, but what we're talking about here are specific techniques to speed up repayment of debt on a fixed budget, which is the way most people actually are. Now, we'll skip the obvious advice of getting a second job, selling some property, applying bonuses or tax refunds to your debt. Let's suppose you're already doing all that. So what then are the approaches to pay off debt effectively on a fixed budget? The first method is called debt stacking or debt avalanche. According to this method, you're going to rack and stack all your debts according to the interest rate they charge from highest to lowest. Let's say you're working as a freelancer and you have 4 debt obligations. You have a car loan, which is $8,000 at a 6% interest. You have a student loan, which is $26,000 at 4% interest. You have a credit card, which is $10,000 at 18% interest. And finally, a leftover IRS tax bill, which is $4,000 at 8% interest. The order of payoff would be in order of descending interest rate regardless of amount. So you would then have the credit card first, IRS tax bill next, car loan next, and then the student loan next. You would then make minimum payments on the bottom 3 debts while sinking everything you have into the 18% credit card at the top. When that is done, you'll work your way down to the 8% debt and so on. The advantage of this method is that by tackling the high interest rate first, you'll save a lot of money over the long haul. The one major downside of this approach is psychological. Because this method ignores the actual amount in favor of the interest rate, you're stuck paying off a very large bill where you might not see a whole lot of progress for quite some time. Eventually, the payoff rate will accelerate, hence the name avalanche in the method, but it will take some time. This method is best for the rational and mathematical folks who trust the numbers behind the technique. Most people, of course, are not like that, hence the existence of the next method. Method number 2 is called a debt snowball. According to this method, you rack and stack all of your non-mortgage debts according to the amounts, with the lowest amount first. So if we keep the debt numbers from the previous example, you have the following slight rearrangement. You would have the IRS bill first, car loan next, credit card, and then the student loan. You would then make minimum payments on the bottom 3 debts while sinking everything you had into the 4K amount on your IRS debt, ignoring the interest rates. When that is done, you would just work your way down to the $8,000 car loan and so on. The advantage to this method is purely psychological. You will eliminate the smallest of the debts fairly quickly and feel like you're making progress, which will motivate you to try even harder. Mathematically, of course, you're going to end up paying more interest because in our example, that 18% credit card is not going to get a whole lot of attention for a while. Debt payoff is like dieting, however. We all know what needs to be done, but whatever method is psychologically the most doable is the one that's likely to be followed the best. Okay, now method 3 is balance transfers. This mostly applies to credit cards. The idea is to open a credit card that has a very low interest rate, much lower than the current one you have open, and then transfer the balance from your current card to this new one. Many of these low or 0% credit cards only offer this for a limited amount of time, say 6 or 12 months, so it can be a bit of a hassle to continuously open new lines of credit, transfer balances, then repeat the process again. But considering that you won't have to pay any interest rate in that time frame, it may be worth it for you. Note that doing this too often will ding your credit, so look for credit cards that have a lengthy amount of time where there's a 0% APR. Okay, the final method is the consolidation loan. If you have good credit and you want to consolidate a number of loans, you can take out a personal consolidation loan from a bank or credit union. This is especially a good idea in a time of low interest rates such as now, and what the bank will do is they will issue a payoff amount for each of the loans you decide to roll over into the consolidation loan, such as your credit card, auto loan, and then you'll just have one lower interest monthly payment to deal with. Okay, so these are the essential concepts on debt, how to minimize or avoid it, and how to pay down quicker with certain techniques. As always, be sure to subscribe to this channel for much more useful videos such as this one on both investing and finance topics. And if you enjoyed this video and found it useful, please smash that like button below and also leave comments as to what other financial topics you'd like to see me cover. As always, thank you for watching, and I'll see you all soon.